Good morning, Francois. Nice to see you.
Good morning. Nice to see you
Well,
too.
welcome back again. I want to talk about the U.S. macro situation, which has been quite interesting the last few days. A massive step change there. Just very quickly, I wanted to come back to the subject we talked about last week, which was Chinese equities and the Chinese market in general. In fact, um, you cautioned against jumping too soon into the Chinese stock market, quite rightly, as it seems. As it transcends. Now, there was a very interesting announcement made by the Chinese Securities Commission, and they said, or words to this effect, excuse the translation, we would urge institutional investors to invest in the stock market with more enthusiasm. Can you just say what that means?
That means state intervention, the way they did it already in the past. They have done that in 2016, 2015, 2016. It means that they are getting very fed up with the development that they see on the equity market. You know, for the last few months, few weeks, few days, because last week there were many news and etc., they are really trying to put a floor on this market. And what they say, they warn the institutional investors that they don't want them to see shorting the market. They have introduced some rules that forbid them to do so. So they really are trying to tell the people who are shorting the market. You know, for example, you had news that one of the Chinese hedge fund got really squeezed in January. And so they are telling them, be careful because we are ready to take any necessary steps in order to put a floor on the market. And we are not going to remain on the side. We have the ability to act even more than we have done up to now. And the fact that Mr. Xi is going to speak with the regulators, which was announced over the last few days or yesterday, I think, it's telling you that really from the top of the state, there is now a desire to see a stabilization on the market.
In other words, traders who wish to bet against the Chinese market, they're betting against the Chinese government, in fact.
In fact, it is exactly that. We can discuss at length, and this is one of the reasons because when you asked me last week if it was the right time, you know, you still face in China a big issue, which is the macroeconomic pictures and the development that you will see structurally in China in the coming years. And, you know, to intervene, to try to stop short, to oblige institutional to purchase because you had significant amount of Chinese shares that were purchased by through ETF by some institutions and they want to reinforce that. It doesn't mean that you have solved the medium-term situation, which is basically the growth is slowing. You still have an issue with deflation. There is a lack of confidence among consumers. So you have to deal with that.
Can we therefore assume that if the market doesn't stabilize, the Chinese treasury will intervene in the stock market and they will start buying Chinese stocks?
It's a possibility. You already have some institutions that are purchasing ETFs. So there is, in a way, an indirect, it's not the treasury, but it is the institution connected to the states that are purchasing the stock market through ETF. But you know, the Chinese in this case is not the only country to do those kind of things. Remember what Japan did in the course of the last 10 years. You had intervention by the Bank of Japan who purchased a lot of stocks through ETF in order to support the market and the economy.
All right, that's enough of that. Let's go to the U.S. macro situation now. There's a number of things happening this week. Initial jobless on Thursday, obviously, which may become more important than most weeks' initial jobless because of the non-farm payrolls last week. The other thing I noticed was the 10-year auction on Wednesday and the 30-year auction on Wednesday. The account I was reading was that they were expecting volatility around those two auctions. Would you agree with that, and why?
Yes, I would agree with that for one reason. Look at the behavior of the bond market in the US over the last 10 days. This has been very erratic. Remember that we were close to 415, then it went down nearly to 390, 388, and then with the numbers, not only the non-farm payrolls, but other numbers that came out, suddenly, whoa, in a matter of 2 weeks, we had a significant correction on the treasury bond market connected to the fact that suddenly people realized that the bet for interest rate to be cut in March is over. The bet for May is getting, I would say, shaky. And more people realize that the Fed is going to act very slowly. And they have all the reason not to bring the interest rates down too early because it's dangerous considering the economic number that were published. So yes, you have all the condition to see some volatility on the market because remember what happened last year in the summer. We had we had a correction on the equity market, which was overdue because the market went too far too fast in terms of progression. It was connected to development on the bond market. Again, volatility came back on the bond market and it fed into an equity volatility. Maybe we are in a position right now where the bond market is going to spoil the show because this is a significant move. So yes, I expect that those auctions are going to be very interesting. We need to watch them very carefully. If some people who are were on the side in the course of the last few days, or were deciding that to be long bonds was not very interesting anymore, are they going to make their mind because the yield are up so significantly? And are they going to come and really purchase bond at that level? Or would they consider that we need to go a step further, like 425, before bonds get back to an interesting entry point?
Now, there's some interesting when you look into the figures, you go a little bit deeper than just the surface. Some people were suggesting that some of the job creation or a lot of the job creation was in part-time work.
Yes.
And that would be hiding difficulty in the US economy rather than being a positive sign.
Yes, I agree. This is one of the negative, I would say, negative part of the thing. Nevertheless, you have other things that are not that great. The first thing that is not that great is that average early earnings went up 0.6%, significantly more than what was expected. Okay, because we were at 0.3 the months before, and people were expecting 0.4. So it means that year over year, 4.5% instead of 4.1%. So it was higher. This is not a good sign. I agree with you. You have the two, I would say, one negative sign for the growth. It's that you have partial job creation. You have negative sign for inflation, which was reinforced yesterday, by the way, by the evolution of price in the ISM index services, which went up 7 points, which is quite significant. So you have more inflation. Last week also, you had some very good news on the inflation front. You had unit labor cost less than expected, and you had productivity growth much higher than expected, which tells you that you can have higher wages. So why was the numbers of the non-farm payroll so significant? It's because suddenly people said, okay, we had one scenario with the certainty of 100% that it's going to materialize. It's going to be a soft landing, no problem, and etc. And suddenly, with the macro numbers that came out, people realized that they need to reassess different scenarios. It's not all negative. In the numbers, it's not all negative in terms of inflation is back. It's not all positive because growth is going strongly. It means that people need to reassess their scenario probabilities, especially in connection with one key element, which is when will they lower interest rates? And that's all. If you want, it's the landscape, the macro landscape for the coming 6 to 12 months that need to be reassessed. It doesn't mean that it needs to change, but people need to integrate all those figures and say, what is the probability that this soft landing scenario is going to be realized? I'm not saying that it's not going to be realized. I'm just saying that people are reassessing. Do we have the right probability? Because, when you get into a point where you say, we have to wait 5 more months before interest rates get cut, it will have an impact in terms of economic activity. Maybe it will be moved too late. But nobody knows. But they need to reassess the situation.
It's one of the things you pointed out in one of our earlier videos that real interest rates were in fact very, very high. And as months go by, they become higher, whether
Yes,
or not
because
that's sustainable or not. But please go on.
you have two elements. Real interest rates are going up. One of the reasons being that inflation is coming down. Real interest rates, which you need to assess, it is not something that is, it's theoretical. You need to assess. Okay, when inflation comes down, real interest rates is going up. On the one side, you could say, yes, they are too high. But, productivity, as I said, is increasing more significantly than what is expected. What does it tell you? It tells you that the growth potential of the US economy is higher than what people were expecting. If your growth potential is higher, it also means that your real interest rates need to be higher. Okay? So there is now, if you want, a fight between the one who are saying the very good numbers on productivity justify that we are living with higher real interest rates. And you have the one who are fearful, who are saying, oh, the real interest rates are too high, the economic is going to slow down significantly. If you have productivity growth, normally your economic activity is not going to be that bad.
You're one of the ones, ever since I've known you, who've been cautioning against an early drop in interest rates.
Mm-hmm.
Your target has always been June, July. Are you pushing that back now with the recent GDP numbers and the recent non-farm payrolls?
No, I think that it would be because also in my scenario I integrate the fact that you have politics intervening in the process. And when you look at the declaration of Mr. Trump about the fact that you want to fire Mr. Powell if he wins the election, politics is also something, even if they will never accept and never say it, politics is also part of the game when it comes to monetary policy. Because after June, you have a problem. If you lower interest rates because the economic activity slows down too significantly, then there is the ability for politicians to say, you are helping my opponent by cutting interest rates in order. So he needs to take that into account. I still think that June is the right spot. But it could even be May. Maybe you will see inflation fears that have mounted in the course of the last few days. To a certain extent, maybe those fears are going to disappear because the next numbers on average early earnings or the next numbers on ISM prices are going to come down again. So it depends on that. For me, June remains the right spot.
What is the question you would have liked me to ask you this morning that I haven't
What
asked you?
I think no, but you have the two questions because the world is still focused on two main elements, which are the US economy, because we all know that the soft landing scenario depends on the US ability to have a gradual slowdown and to remain in positive growth, and the Chinese situation, because the Chinese situation is very important, especially for emerging market. The question that you could have, we alluded to it last week, it's still this geopolitical situation. People tend to completely put that on the side. Events lately in the Red Sea remain, to a certain extent, frightening. There is not an escalation, but at least there is no de-escalation. This situation is very tense, and I think that one question would be, geopolitical does not matter, or I still think it does matter and people need to keep an eye on that. And the other question that you could have is the US dollar strength going to continue? Because the US dollar has been very, very strong due to those very good numbers and the Fed meeting and Powell declaration. So I still reckon that in the short term, there is room for this consolidation. We discussed that already. I still think that in the very short term, the US dollar is going to remain strong, but medium term, I keep with the idea that it's going to be above 112 by the end of the year.
Thank you very much, Francois. It's been lovely speaking to you again. I hope we speak next week.
You're welcome. Bye-bye.
Bye-bye.